Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. Equities across the region are flat. That's ahead of some key economic data coming out of China over the next hour. Investors are looking to build on gains after mainland stocks closed at their highest level this year.
We're looking at long-dated government bonds also in focus here in the region, with Japan's 10-year yield climbing to the highest level since 2008.
Meanwhile, traders weigh the impact of President Trump's tariff threat against Russia over its refusal to sign a ceasefire deal with Ukraine.
And Chinese President Xi Jinping set to meet Australia's Anthony Albanese today as Canberra seeks to walk a fine line between Washington and Beijing. We start with some breaking news. We are getting some lines here from Reuters that is now reporting about some shifts and changes when it comes to the central bank there in Thailand. So the finance minister, according to Reuters, will today propose a cabinet state-owned bank head, Vitai Ratanakorn, as the next central bank chief. That's according to their sources there, but that appointment is subject to cabinet as well as royal approval. So that is the latest change that we're seeing possibly from Thailand here this morning, Dave.
Yeah, and let's see whether that in some ways remove some of the uncertainty and risk premium that's been built into that specific market. Of course, we'll look at that in a moment. But as we speak, and how quickly things can change. Earlier on, about an hour back, we were looking at mostly green, and as you can see right now, it's mostly the opposite. Taiwan, which was a little bit green right now in the opening moments, has now turned red on your screens. Lots of event risk on the table today. In the next hour, you have data coming out of China. Of course, the U.S. CPI print, that's going to be very key, of course, on the back of flip the boards, please, expectations that at some point, and will that point be now, tariffs start to show up in inflation numbers coming through. Right, the read across currency markets, just keep in mind, of course, this is from the cutoff today, so as you can see, it's fairly inconsistent, but it's really about dollar strength compared to this time yesterday. The other thing we're tracking as well, given the whole macro conversation, is this really bad moment government bonds are in. If you look at the last, 6 or 7 days, call it a week and a half, we're looking at the worst 6 days for government bonds going back about 2 months or so. Front and center is a Japanese yield, which at one point in the last hour was actually above the 159 handle, which, as things stand, still effectively is the highest level on Japanese yields here, going back to 2008. Gold, silver's coming up. Silver was a big talking point overnight, almost at a 14-year high, has stabilized since that point. And Brent crude, as you can see, declines right now. Goldman out with a new forecast on Brent, second half 2025, up by about $5 to that level you see bottom of your screens. And speaking of coming off highs right now, Bitcoin, which was closing in, I think, on 125 yesterday, is now below that 120,000 handle as we go into the session today. Yvonne.
Yeah, Bitcoin's kind of doing its own thing, really, against all this headline risk, it seems. We'll talk about Crypto Week in the U.S. coming up as well. In terms of your agenda here today and what to watch out of Greater China, it's earnings. We'll break down kind of what we have seen so far when it comes to every sector you can think about, really, from property, from airlines, the like here. Of course, that data dump coming through at the top of the hour. June home prices come first and foremost here, as we will talk about a bit later. That credit data came out yesterday already with a bit of a preview of what's to come. Albanese in Beijing, of course, we'll talk about that trip and really that fine line he has to tread between, choosing sides, or at least avoiding to choose sides between the U.S. and China. And there's a press briefing from John Lee here in Hong Kong, and HIBOR as well. We've been talking about HIBOR now hitting a 2-month high. So watching the property space here this morning too, Dave.
Yeah, we're back above 1% on that one specific level there. We talked about earnings, right? So Yvonne just mentioned we're starting to get a flurry of big names coming out with guidance for the first half. And of course, these, keep in mind, are typically a range of guidance coming through. Just a snapshot, really, of the big names that have come out with guidance as of right after the close yesterday. So we'll talk about Vanke in a moment, and to the point Yvonne was making too, property prices will come out as well today. So lots more to discuss, and of course, market reaction to many of these
Yep.
which have come through over the last, let's call it 12 hours or so.
Yep, our top story here this morning still is what we're expected here in just about less than an hour's time, China's data dump. Now, the economy probably expanded just above the government's full-year growth target in the second quarter, and that is easing pressure on Beijing to roll out additional stimulus in the near term. Let's get to our chief North Asia correspondent, Stephen Ingles, there with the latest and what to expect here today.
Yeah, the numbers are a little bit all over the place as far as the estimates. So the consensus estimates for GDP growth, retail sales, industrial production, fixed asset, urban investment are all below the previous quarter, in the first quarter. But again, Bloomberg Economics is a little bit more bullish. They see the numbers a little bit higher than the second quarter. That just illustrates the uncertainty with the impact of the trade war, the truce, and then the unwinding of the truce, and then another truce, and front-loading of exports. We saw the export numbers and the trade surplus rise to a record yesterday for June. So there's a lot of competing data here because the underlying I don't want to call it weakness, but sluggishness in the Chinese economy is still there. And we'll talk about what the second half outlook looks like in just a minute. But essentially, Bloomberg Economics thinks the Chinese economy in the second quarter gained momentum from the first quarter to 5.6%. Industrial production, 6.1%, which would have been an acceleration as well. Retail sales holding steady because of the cash for clunkers trade-in program of appliances and other items helped boost some consumer sentiment and consumer spending. So retail sales at about 6.4%. Stimulus also helped with the overall outlook for the second half as well. But again, the questions now, does this momentum in the Chinese economy mean less stimulus going forward? Because there's going to be several meetings coming up. You have the party Politburo meeting later this month. We could get some sort of policy statements there. And then there was all kinds of rumors in the last week about possible property support as well.
What does it mean for the second half? Is what we've seen momentum, or is that front-loaded, which could be momentum, but it could be something else?
Yeah, it all depends on how the relationship goes forward with the truce between China and the United States, where that actually leads to tangible and real results on the negotiation front and a lasting peace. And again, I think we do have to look at the property sector because after some signs of positivity, we've seen sluggishness again in sales and activity in the property market. There were all those rumors that I alluded to just a few minutes ago about the Central Urban Work Conference possibly convening soon, and the last time it did in 2015, we saw Beijing launching that shantytown renovation program that led to cash handouts to households, that led to them buying apartments, which led to the property bubble that we saw unwind in the last couple of years. But again, it's potentially putting a floor on that weakness in sentiment and in spending in the property space. State media, though, has given no indication or no clues that that actually is going to happen. I would actually really focus in on the Politburo meeting, convened, the top 24 policymakers led by Xi Jinping later this month that could possibly give better clues as to how much stimulus and how much stimulus is needed. Keep in mind, we had the central bank, and you're going to talk about this in greater detail in just a minute, I believe. They reiterated that the PBOC will plan to enact a moderately loose monetary policy and keep liquidity pretty ample.
Yeah, Steve, thank you so much. Stephen Engel, Chief North Asia correspondent there. In fact, as Steve was alluding to there, we also did get the credit numbers. I think this is for the month of June. Yeah, there we go. Yeah, and almost a beat across the board here. M2 aggregate financing, but of course, these are year-to-date numbers, and you sort of have to do a little bit of work to make out that sort of monthly data.
June is usually a good month for credit data. You do see things sort of expand because a lot of these banks they need to be lending out more to reach their quotas and the like. But also this time around, it seems like it was due to a lot of government bond issuance as well.
Yeah.
So is it really a sign that animal spirits are back? Broad-based private demand? Maybe not so just yet.
Yeah, I'm curious to see what the actual. There's a measure here of mortgage and the takeout there as far as credit goes, right? And really on the back of this property market, which was okay actually going into the first couple of months of this year and has lost somewhat of momentum there. And I think we get an update on that, of course, in about 21 minutes from now, with new home prices coming out, We've seen an acceleration there of the losses or the decline in prices in the May data. Helen Qiao joins us top of the next hour to unpack all of those things when we do get those numbers come through.
Yep, let's get to one of our other top story here this morning as well. President Trump has threatened to impose stiff financial penalties on Russia if it does not end hostilities with Ukraine. He's also promised to send more weapons for Kyiv, including Patriot air defense systems.
But we're very, very unhappy with him, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is.
Let's bring our news desk editor, Jill Deesis. She's with us now. I look back at that scene and I think back of what happened in February when Zelensky sat on that very same chair. And what the president is saying now seems completely different than what we heard a few months ago.
Yes. Well, Yvonne, I think that the big thing to keep in mind here is, this may be a reflection of Trump's frustrations with being able to reach a ceasefire. I mean, remember, back when he was campaigning, he pledged that, he was going to bring them to the table and, reach an end to the war within, the first day in office or some such, right? So I think the fact that this has dragged on for as long as it has clearly has irritated Trump. And so now, I think he's clearly just trying to put some pressure on Putin, trying to put the ball in Putin's court. And his inability to sort of, get Putin to agree to a ceasefire is what ultimately leads us in this position. I'm not sure how effective applying secondary sanctions on Putin is going to be for bringing him to the table versus getting him to stop military actions in Ukraine. But I do think that does indicate that Trump at least is, trying some different tactic here. His language, I think, is a little bit difficult to parse, but what we have heard from Trump allies is that effectively what he's implying is this would be secondary sanctions on countries, potentially China, India, that import Russian oil. So that idea of trying to, create some kind of an economic blockade on Russia by targeting, those that do business with Russia in that way, rather than just a straight-on, tariff against Russia, which, when it comes to the U.S. and Russia, I'm not really sure that has very much economic impact alone. But yes, it does kind of show you that I think, Trump is clearly getting frustrated with Putin as the situation develops, trying new tactics here and ultimately trying to strong-arm him.
I'll borrow your blockade concept there because when you talk about, I'll bring in the EU part of the conversation here. They've used the concept of prohibitive as far as the tariff goes, the threat from the U.S. What's the latest there, and does that mean they're about to retaliate?
Yeah, I think when it comes to the EU, it's really difficult to tell because, again, it's at this point with Trump, it's sometimes so difficult to tell whether what he's applying in terms of these tariffs is a final answer, essentially, or if it's something that leaves room for the negotiation. So markets, for example, have broadly, and actually many of these countries that have been targeted with tariffs over the last couple of weeks through these letters have broadly interpreted that to mean an extension of what was initially an early July deadline to August 1st. Now you've got Trump kind of muddying the picture a little bit. I think his latest statements was that the letters that he's been sending out to countries are deals. He said the deals are made, there are no deals to make. But then in the same breath, he's kind of saying, oh, well, when it comes to Europe, which is being threatened with a 30% tariff, you still want to have a deal, still kind of want to negotiate. So again, I think that kind of language from Trump, where it kind of feels like he's talking out of both sides of his mouth a little bit, wanting again to kind of, play the strong man here, drive somebody to a deal saying this is final, but at the same time opening the door here. It's, again, makes it very difficult to tell what's going on with this EU situation because, yes, the EU has said that essentially if you're tariffing, applying 30% tariffs on all goods, that really effectively prohibits transatlantic trade. So we'll see if that ultimately leads to some kind of a deal or if Trump is going to hold firm on this 30% idea.
Jill, thank you so much. Jill Deesis there, our news desk editor. Coming up here on the show, we'll be speaking with JPMorgan Asset Management on their EM strategy for the second half of 2025. Joanna Shen joins us right after the open, of course, which comes through in about 16 minutes from now. We're counting down to the bells in Shanghai, Shenzhen, and here in Hong Kong. This is the China Show. Good morning.
the things about Australia and China that's so important is that we build people-to-people relations, and we do that by the participation of Australians here, whether it be here in football, whether it be the business relationships that we have here as well. I've brought with me a whole range of business people from the resources sector, the tourism sector, from the education sector.
There we go. At the Bund in Shanghai, the Aussie Prime Minister there, of course. And Mr. Albanese, of course, is set to meet Chinese President Xi Jinping on Tuesday. And the meeting in Beijing this time comes amid these tariff threats and reported U.S. demands for commitments from Canberra as it pertains to Taiwan. Let's bring in James Mager, our senior reporter for the Chinese economy and the government. James, what is Albanese looking for? What's a win looking like for him?
I think from the Australian side, actually, there is that it was very clear going in that they didn't have actually a lot of really big requests for new policies for changes from China. Obviously when he came in a couple of years ago, the relationship with China was terrible, and his government has done a lot to stabilize that relationship. Now there's no more tariffs that were imposed during COVID. All the blocks on Australian exports have gone now, and the relationship, I guess, is back on an even keel like it was before the pandemic. But the Chinese side had been pretty clear that they wanted to now take the relationship to the next level. They wanted to upgrade the FTA. They want to do more cooperation, and they want more access to investing in Australia. Whereas the Australian side, I think, has been very much, we're pretty satisfied with how the relationship is right now. We're back where we want to be. We're not looking to make radical changes or to deepen the relationship in any substantial ways. And so the things he's been talking about while he's been here, increasing tourism into Australia, cooperation on green energy, cooperation on decarbonizing steel, for example, which is a huge portion of the trade between China and Australia is basically steel and iron ore, coal. And these are things, these are in some senses low-hanging fruit. China exports a lot of solar panels and batteries to Australia. Australia wants to decarbonize its own energy supply chain. So these are areas where cooperation and more trade is logical. But really doing anything substantial, I think, is really not on the Prime Minister's agenda while he's here.
Yeah, and it comes across a pretty awkward time, right, given the fact that the Trump administration has in some ways asked for Australia's stance in light of, in the case of whether, one day China attacks Taiwan, and really kind of what Australia's commitments are going to be. What about when it comes to Beijing? What does Canberra want from Beijing specifically?
On the defense or on the security side, it is a very, very difficult relationship, and it's getting more difficult. You saw the PLA Navy sailed around Australia recently and conducted live fire drills in the Tasman Sea. Obviously, totally legal. It's international waters, but there was a big outcry in Australia about that, and the Prime Minister has to walk a fine line between dismissing those concerns, but also because it is legal. At the same time, making sure clear to the Chinese that they would like more warning about these kinds of things, because that is going to continue to happen, and as the PLA Navy gets bigger and bigger, it's going to be going out more and more and going out to other places. I mean, one thing I think the Australians really do want to try and get traction on, or to get improvement on, is how do the Australian military and the Chinese military deal with each other when they come in contact with each other. It's been specifically an issue in the South China Sea, where Australia has complained that China has unsafely intercepted Australian planes, which are doing surveillance there. It happened also in the East China Sea, where the Australian Navy claimed that some divers were hurt by Chinese sonar. So there is a real desire from the Australian side to have better relations, military to military relations. But yeah, the security side is a real issue. And as has been reported, as you said, what happens with the Taiwan situation for Australia, for Japan? How do those countries act if there is a war in the Taiwan Strait between the US is a real question. Obviously, no one is going to give us a firm answer to that now. It's not going to be China, it's not going to be Australia, but everyone is thinking about that.
James, thank you so much. James Mager there, our senior reporter for the Chinese economy and the government. As James was speaking here, just to mark we're looking at the JGB market very closely. So after the 10-year yield hit the highest in 17 years, it's now the 20-year highest since at least 1999 on that specific level. And we're also very close to hitting a 99 high on the 30-year yield. Stay tuned for that once that, of course, comes to fruition.
Yeah, it really started with a 40-year yield yesterday, really leading the charge in this sell-off. And what we're seeing here is, there's a bit of angst leading up to these upper house elections in Japan, and maybe traders are removing that risk ahead of that July 20th date. But it wasn't just Japan, right? You saw that the tumble in treasuries, in German bunds overnight as well. So we'll continue to track this one here this morning. There you go, at around 2.64% for their 20-year JGB yield this morning. Let's switch gears now and bring it back to China. The embattled builder, China Vanke, has deeply apologized for its performance in the first half of 2025 as losses threatened to reach almost $1.7 billion. Let's bring in our China correspondent, Min Lo, on just how significant or the scale of these losses, Min.
Yeah, this is their second year making losses now. At least the first half of the year, we're looking at expectations of between 10 to 12 billion yuan. It's a widening of the loss that they had in the same period last year of about 9.8 billion yuan. And this is coming from a decline in the scale of their real estate projects, settlements, profit margins remaining quite thin. And it really underscores how the real estate crisis in China has still been dragging on after 4 years now, despite some of the government stimulus, right? You look at the home prices, home sales, both continuing to decline in June. We'll be getting the July numbers soon. And Vanke, they have managed to escape default so far after getting a bailout in some ways from the controlling shareholder, Shenzhen Metro. It's a state-owned company that provided a new round of financing for the company. The Shenzhen government also took over the reins of the company earlier this year. But still, its fundamentals are quite weak. And right now, there has been a lot of speculation about whether or not the government will step in to intervene in the housing market in a very big way. That started because of some social media posts. But so far, if you look at state media, though, there hasn't been any signals that the government is planning to do what they did in 2015, which was a very ambitious plan, a shantytown redevelopment program, where the government built a lot of houses, provided subsidies for housing that really led to this housing boom. But right now, the circumstances are very different because you have oversupply, you have a demographic decline. It's very unlikely that the Chinese government will look to recreate the sort of environment and start to build houses again.
Min, thank you so much. Min Lo, our China correspondent there. Vanke, slightly unchanged largely, really, in the pre-markets. Going into the open today, so we're looking at, it's quiet, 0.3% to the upside on Hang Seng China. Similar gains when you look at the Hang Seng Index. It's really not a lot of big movement within the index constituencies. A preview of the trading day just ahead. This is the China Show. Welcome back. You're watching the China Show, just under 4 minutes away from the opening bell. Also under 4 minutes until we get the latest iteration of home price data. As of May, here's our chart, 24 straight months. And here's what's key here, a reacceleration to the downside here of sort of your average in terms of new home prices. So we'll see what the update looks like, Yvonne, when we get that at about the open today.
Yep. So far, the data has looked pretty good. We take a look at credit data, the export and imports and trade data we got yesterday as well. A good sort of prelude to what we're expecting at the top of the hour with that data dump as well. Pre-market is looking pretty good in Hong Kong. We're up about a third of 1% and a stronger slightly currency at 7.1711 against the dollar. The open is next. This is Bloomberg.
Right, welcome back. Going into the open today, a couple of things here. We have data coming out, property prices. 30 minutes time, we have the data, including the growth numbers within the markets. Of course, the key theme is this four-syllable word, involution. A concept that I was told that applies to that is effectively just think of yourself doing a set of crunches. And by the time you get to number 30, if that's your maximum set, 28, 29, you're starting to struggle and you're starting to turn inward. I'm not sure is that a good way of putting it?
That's a very accurate, literal sort of way of interpreting it. But it can be applied to many sort of facets of life we're just talking about, right? Yeah. It's like, getting up in the morning, the work. Yeah. Nature.
Except though when we start the China Show, which is the complete opposite of nature.
That's when I don't know. What's the opposite of nature? We'll see. You wake up and you watch the show. show, right?
Yeah,
Take a look at how markets are doing. We continue to brush off the headlines, right? And that certainly is the key case here. I mean, the data that we got in the last 48 hours or so have been pretty good when it comes to China. So is this sort of rally, can it extend based on fundamentals? It's certainly one key question that we're asking. And CSI 300, as we just talked about, did finally reach those 2025 highs on Monday. So we continue on with this rally. Shanghai is pretty much flat there. But we are watching very closely what goes on when it comes to some of these big names like CATL, the likes of Qiao. Not doing a whole lot here this morning. It's sort of the big names. But it's interesting, right? We had the likes of UBS Securities talking about this AH share premium, which basically we have seen that premium shrink in the A share market. They're saying that's going to stay near the lows, that gap, throughout the second half, because this whole weaker dollar story is only just going to enhance more liquidity in Hong Kong and really get the southbound flows basically will continue, and people will continue globally to buy from Hong Kong. So certainly that's sort of the trends that we'll be watching very closely. Hong Kong is doing this here right now. When it comes to earnings, there's a lot on tap, everything from airlines to commodities to even the property sector that we're likely to hit there. So we'll watch that as well. And if we hear any sort of tariff impact in terms of the guidance here as well. Hong Kong is doing this. Can we flip the boards and see that, guys? Right now, the pre-market was showing pretty good, right? We're up 0.5%. And I think we got that home price data, right?
Yeah.
Coming through now.
And yeah, I mean, so not a good set. That's the headline. So new home prices for June down about, and we need to go 2 decimal places here in this specific case here, negative 0.27% month on month. If you could ask my producers to also bring up chart 2402 when you can, please, as well, just to show you how that looks, that acceleration to the downside. New home prices down 0.27, used home prices down 0.61%. That's also month on month. That's also faster than May. So we're now down 25 straight months. Charts coming up on your screens very shortly. And you can see, of course, rightmost side towards the bottom is that bar chart that shows you, again, 0.27% deeper decline compared to what we saw back in May.
All right, let's bring in Joanna Shen now, EM AP Equities Investment Specialist at JPMorgan Asset Management. Joanna, it's great to have you on the program. I mean, the property side of things, continues to be sort of in the doldrums in some ways, but still we're talking about equity markets in China that are doing quite well for this year. I know you're not a macro-driven sort of, specialist, but I'm just wondering, how does it help in terms of stock picking then in this sort of backdrop?
Yeah, I think the key thing in China this year is definitely the technology breakthrough with the emergence of DeepSeek, which hugely enhanced the confidence in China. And we do see China has a lot of user cases for AI applications, as well as a lot of talents in the AI space. So I think that will definitely rejuvenate the interest and the sentiment in Chinese equities. But on the other side, we do see some of the long-term structural kind of overhang remains. As you've reported, the property prices is still trying to find a floor. But the green shoots here in the property market is we do see a better supply-demand dynamics. We see more sort of contained like land sales. But on the other side, we do see on the demand side, the government has been doing some measures to ease the demand as well. So I think it's still a case of finding the floor, but with marginal improvement in the property market. But nonetheless, the valuation in China is still not expensive. As well, if you look at the tariff side of things, China is still quite insulated from the tariff sort of noises, given its revenue base for MSCI China is still largely domestic focused. MSCI China's revenue is 10% to overseas market, out of which 3% to US market. So I think all these confluence together sort of paste the picture for Chinese equity this year.
Yeah, and we mentioned, I think, to the point Yvonne was making on, I think, the economy and consumption, a group of names that's been really dumped quite heavily are some of the consumption, the platform, some of the names. I'm not going to get into specific names, but I wonder if that's an expression, that's a good expression of, your views around Chinese consumption, because some of these names do seem to be trading well below their historical averages already at this point.
Yeah, I think the story of consumption is of two tales. On the other side, we see some of the new economy consumption names is really doing well. But on the other side, some of the traditional consumption names, because of the policy, because of the deflation pressure, is still sort of under the water. But I think we do see some sort of consumption names with moderating competition, where we are slowly building positions in consumption. So I think it's, again, down to the bottom-up stock picking. Some of the new economy consumption names, they had a huge run, but we do think valuation right now is a bit toppy. So we are actually doing the opposite, trying to look some contrarian consumption names with moderating competition.
Where are you seeing?
It's more in the restaurant space. Definitely.
Restaurant space. Oh, okay. That you actually are seeing margins not being too compressed.
That's
right
very
now?
Moderating
Moderating at least. Yeah. Okay. How do you view this whole
anti-involution
sort of trend?
Yeah,
where
I think
people are saying it's quite equity positive if things are actually executed the right way.
Yeah, speaking of involution, which is the buzzword of the day, so I think Chinese that definitely have the genes of involution, which could date back to the Asian farming time or the Confucian sort of respect and value for hierarchy. So we do, if we look at this round of the anti-involution campaign, compared to the 2015 and 16 time, it's quite different. So back then, the overcapacity is concentrated in the upstream, SOE-dominated kind of area. And we do see last time the government is quite clear giving a mandate of cutting capacity. They have a target of 10 to 15%. But this time around, because China has also progressed, evoluted, so this time the overcapacity is in areas like EVs, like solar. It's more concentrated in the private enterprises. So we do think this time the approach could be different from last time. It will be more market-oriented, which could be emphasis on policy guidance, on coordination of the sector association, as well as the self-discipline of the key sector players. So continuous monitoring of the effectiveness of this campaign would be key to understand the impact on the equity market.
Okay, one last question on China before we talk about other markets. I think Korea has also been on quite a rapid ascent. Chinese biotech this year has been substantially bid. I think it's the best performing sector. How are you thinking about opportunities still in biotech?
I think in terms of biotech, again, it shows China is moving up the ladder chain in the global kind of manufacturing kind of space. It's not just cheap white goods, but also we do have some R&D capabilities in that side. But having said that, valuations gets a bit rich at this stage, so we are watching and monitoring in this space.
I know you want to talk about Korea, which is where you actually have seen maybe a bit more conviction right now. Tell us a bit more why. Why still stay positive in Korea after already a pretty tremendous run?
Yeah, I think if you look at the Kospi index, actually finished the first half with a trailing PB rate at 1 times. So looking at the 10-year historical range is still not demanding, I would say. And if we look at the past kind of performance stats, if you buy Korean equity at the current level with a 12-month view, the odds for the market to go up and go down are evenly spread. And that's number one in terms of valuation. And number two, if we look at the foreign participation of the Korean market, right now it's around 33%, still about 7% lower than historical peak we see in late 2019, which is around 39%. That's number two. And number three, it's more domestic related. So we have a very market-friendly president. And we see this urgency from President Lee to roll out some measures to fulfill his campaign kind of pledges. So one, we see a 30 trillion won kind of supplementary budget to boost the domestic economy. Two, we do see some appointment of industry specialists from LG, from NAVA, to lead the government AI-related initiatives, which is a positive boost to sentiment. And number three, most important, is the revision of the commercial law. And central to this is the revision of commercial code, which expand the board's responsibility to enhance shareholder value. And this is one step further than Yoon's Value Up program. And another important pledge is the cancellation of treasury shares. So we do not think all these measures or initiatives will change the Korean chaebols to be the world-class corporate citizens overnight. To us, the Korean corporate governance reform, it's a journey. It's not a one-off event. But we do think it's a step in the right direction.
I'm curious now. Is the play now on Korea, is that an index play? If it's not an index play, are there plays there beyond AI, to your point?
Yeah, I guess you're going to, because the index-heavy kind of memory names.
Yeah, I was going to mention Samsung without saying it, but I did already. You forced me. Okay.
Aside from the semi names, which we are positive because of they do have a leading position in this ecosystem, as well, we do see some domestic, like in the corporate governance side of things, some corporates with lazy balance sheets, more on the financial side of things. Some of the Korean defense name looks interesting as well.
Okay. Joanna, thank you so much. Fantastic. We covered, your best performing market and, of course, where the opportunities are in this Chinese equity market. Joanna Shen there, equities investment specialist at JPMorgan Asset Management. Okay, we've had a ton of breaking news in the last 10 minutes or so, so we'll talk about the home prices in a moment. While we were talking, the 30-year yield in Japan now just hit the highest since 1999, following the 10-year hitting a 2008 high and was it a 20-year? I'm confused now. It was the 20-year that hit the highest
since 2000.
Since 2000. 1999. Yeah, there we go. So that's one story to track. The other thing is, wow, this Nvidia story might be something that moves markets.
Yeah, this is what we're hearing from Nvidia. So the company says they expect to license to sell H20 GPU chips to China again. Why we're showing TSMC, certainly that's the one thing that we're watching in terms of the chip space, and maybe we'll see a reaction in that side of things, because we have seen Nvidia, they reportedly trying to develop at least some sort of H20 AI chip specifically for the Chinese market that actually tries to comply with some of these export curbs in the U.S., right? So that's what the company is trying to do right now. And this coming in the backdrop of Jensen Huang, the CEO, heading to China this week.
Yeah, that's a big midweek event. And if you recall, what Nvidia said during its last earnings statement was they gave actually a number of what their exposure was, revenue exposure to China, and they did give, I think, an impairment of, I remember correctly, $7 billion. I'll correct myself if I'm wrong, but in any case, of course, we'll continue to track this ahead of that visit. And we're now looking at NASDAQ futures. There we go. Speaking of market moving, we're now well off high lows of the day, and as you can see, that vertical line towards the right side of your screens, we're now just down about 1 point. We're now flat on NASDAQ 100 futures. Right? Lots more coming up here on the China Show. This is Bloomberg. Right, welcome back to the breaking news we had just now. What a difference, they say what a difference a day can make, what a difference a headline can make. Coming up on your screen shortly, NASDAQ futures have now reversed all the early weakness. We're now trading about 25 points higher on the back of this headline coming through out of Nvidia. The company expects the license to sell the GPU that they're previously allowed to sell to China. They'll now be allowed to sell it again, is what the guidance is coming through here. That's ahead, of course, of this visit, Jensen Huang in Beijing. And as I speak, we're now up 45 points on NASDAQ futures. Let's get a sense now of what this means and, of course, the broader conversations around chips, negotiations. Catherine Thorbeck joins us right now to talk us through this. Catherine, I'm sorry we had to pivot very quickly on the topic. We'll talk about what we were supposed to talk about in a moment, but can I just get you to react, your initial thoughts on this headline that just came through here, Catherine?
Good morning, David. So yes, this is huge news, and I'm obviously reacting to it. It just came through. I'm obviously reacting to it just in real time. But this really, if this does happen, and if Nvidia is able to sell its own chips that comply with export controls to China, and especially the H20, which was recently cracked down in the China market, it really can't get back into this market soon enough. And we know that Chinese AI giants and Chinese tech giants really still prefer Nvidia's chips. They're superior to Huawei's, and despite all the uncertainty, they still much prefer using Nvidia's chips, and have been stockpiling them before the export controls came into play. And the reason for that is they've spent years, building AI products on top of Nvidia's software, and so making the switch over to Huawei's offerings is a very, very difficult task. And there was some reporting last week that Huawei was working on a redesign that would make this switch over a little bit easier, but Nvidia, if it wants to keep its foothold in the China market, it really can't move fast enough. So this is quite quite stunning news to just come in.
It seems like this could be good news that he's bringing to China as well as he embarks in the mainland and meets with many Chinese leaders too, Catherine.
That's right. So we know Jensen had this planned trip to China this week, and it seemed like he was really trying to sort of maintain his company's foothold in the China market as, competitors like Huawei have risen up. And right now we know that Huawei's offerings, there's a lot of uncertainty about them. We know that they have struggled to, make enough chips and how efficient they are. And I think that if Nvidia wants to really keep its hold on the Chinese AI ecosystem, it really can't move fast enough.
Yeah. Now, the other side of that is, Jensen Huang says there's no issue with them selling. I'm paraphrasing, of course, selling this technology as it pertains to national security. But I think that the piece that you're putting out there and the thesis here, Catherine, is it's going to take more than the words from the CEO to convince the people that need convincing here.
That's right. So Jensen Huang over the weekend in an interview said that we don't have to worry about what's really Washington's greatest fear, which is that China's military could use advanced AI chips. And, I think we should all hope that, as Jensen said, we don't have to worry about this. That would be great. But I think, if we are listening to Jensen's sort of pearls of wisdom, there was another interesting thing he said this weekend, which is that he thinks in the long run, as all these companies are racing to implement and deploy AI models, he thinks it might not matter whether they use American or Chinese models. And I thought that was really interesting because it suggests that he sees AI eventually becoming a commodity, kind of like electricity. And it's arguably already a commodity in the China market. But I think that should be a big concern for Silicon Valley at a time when China's low-cost offerings are looking very alluring on the global market.
Catherine, it's great to have you. Catherine Thorbeck there, Bloomberg opinion columnist. It's almost like we timed it with this breaking news well.
We did.
To have you come on the show. But yes, this quickly, it will probably become one of our top stories here this morning. We'll continue to track this one. In other corporate news as well, Chinese airlines received 3 Boeing jets on Sunday, and the rare same-day handover potentially signaling easing tensions between Beijing and Washington. Boeing has delivered 28 aircraft to China this year. In a closely watched gauge of U.S.-China trade ties, the 3 737-8 MAX jets were for domestic airlines based in Xiamen, Shanghai, and Shandong. Nikkei reports that Nissan and Honda are teaming up to develop shared vehicle software. In a rare collaboration, the two rivals aim to standardize the software powering their next-gen cars. It's part of a broader push to stay competitive as Chinese EV makers gain ground. The move also follows the collapse this year of their $50 billion merger plan. We got plenty more ahead. This is Bloomberg.
Right, welcome back. We're continuing to track the market reaction to the breaking news earlier on of Nvidia and expecting its license to sell again H20 chips to mainland China. But certainly when you look at the tech space in China, the reaction there is quite evident. And NASDAQ futures, we talked about that earlier on, also reversing the weakness coming through. And we're now positive as far as that contract is concerned. Chinese tech stocks are jumping for joy, according to Mark Cranfield, on that expected license coming out of Nvidia.
Yeah, I mean, if there ever was like a sort of risk there for Nvidia, every time we had a guest on, we always talked about China sales, right? Yeah. That was still kind of the overhang over this company. And if that is lifted now, does this kind of clear the way for this whole AI sort of rally to continue and another leg forward, right? Like Mark Cranfield says, the tech gauge has kind of been traveling a bit sideways. He's talking about HS Tech. This just could be the catalyst, he says, to drive HS Tech to a higher trading range. And then we also have data to contend with in the next few minutes. Yeah,
that's coming out in about 8 minutes from now. So you have data coming through, GDP numbers, 5.1%, I think is the median estimate there. It's quite a substantially wide range, more than usual, I think, on GDP numbers coming through. There's that, there's the monthly data dump, and of course we're coming off two things. We're coming off the property numbers, which, as expected, largely somewhat, are expected to show this deceleration in the progress made there. In fact, the steepest decline in new property prices across 70 cities this year so far. And of course, the question is around animal spirits and consumption and how they're able to, I think the interesting bit there, I just thought about it now, is with this involution conversation, right? How do you discourage intense competition, which intense competition has actually supported consumption of late, I think.
And how can you continue to rely on exports to drive growth, right?
Yeah.
When you are dealing with these excess capacity issues, and we're still dealing with terror threats around the world. So certainly that's going to be a key question we'll be asking the likes of Helen Qiao from Bank of America joining us to break down this data as it comes through. But it's interesting, we talked to Goldman Sachs' Shen about that. She says it's a really big question that they're getting from their own clients about those animal spirits and lack thereof. Take a listen.
We get asked a lot, how do you get the animal spirits or consumer sentiment up? If you look at the NBS Consumer Confidence Index, it has been pretty depressed ever since the middle of 2022. And despite the reopening, despite the last September policy pivot, we haven't seen much of improvement in that indicator. Part of me think it's just going to be a lagging indicator. It needs the economy to stabilize, it needs the labor market to improve, it needs people over time to forget about all these uncertainties and difficulties and be more optimistic. So that's almost the last piece of a puzzle fall in place to have a stronger confidence.
That was Cui Cui there. We'll be speaking with Bank of America or BofA Global Research next as we get their reaction to China's latest activity data. Helen Qiao joining us there as well.
Yeah, okay. Just before we get into the break and ahead of the data coming through as well, just to mention the Hang Seng Index, speaking of this new range, is now broken above the high that we hit in late June. And as things stand, we are now trading on the Hang Seng Index at the highest level since before April the 2nd, highest level now since mid-March on the Hang Seng Index. Plenty more ahead. This is the China Show.
Welcome back to the China Show. Here's a look at the HSI. Well, we're not, there you go. So the briefing is underway. We're expected to hear this data dump any second now. But take a look at the Hang Seng. It's doing very, very well. We're at the highest since March of 19. And really, it's on the back of this news from Nvidia saying that they now, or at least have the confidence, that they can start shipping this H20 GPU chips to China.
Yeah.
That was in a blog post, and now markets are moving.
Yeah, and it really removes that key, I think, uncertainty around a key market. I think 20-25% of revenues. They did give out, I think, $5.5 billion was the impairment from Nvidia ahead of that. And of course, not to mention, Nvidia is now a $4 trillion company. So we'll see what happens with this. It's not just the Hang Seng Index, right? Hang Seng Index and many other things we'll revisit in a moment. In the meantime, though, we do have the breaking numbers coming out now, the data dump, including the monthly indicators. I'll start things off with the GDP print. Second quarter numbers, 5.2%. Slightly ahead of the median estimate. Year-to-date GDP 5.3, seasonally adjusted Q-on-Q GDP 1.1, where the estimate was for 0.9%. Yvonne.
Okay, so that's better than expected. What's standing out here is industrial production. So the year-to-date numbers are 6.4%, so that is also a beat. Retail sales, that is the miss, though. We're talking about a 4.8% year-on-year numbers here. The estimate was for a 5% or higher print as well. And fixed asset investments, that also was a miss. So we're talking about 2.8% for that one as well. Property investment continues to be in the negative territory. We're talking about a contraction of 11% or more. So it's a mixed bag, safe to say, Dave.
Yeah, the retail, you're right. It's mixed. The retail sales numbers, perhaps one of the more important data points are given the sort of conversation around consumption, but everything else coming in almost above estimates, and we'll get more context coming through there with this briefing that is just about to start in Beijing. Dollar China on your screen, slightly off lows of the day following the numbers which come through, and the reason we're at those lows in a few minutes or so was maybe down to the risk on news coming out of Nvidia. But yeah, let's get perhaps more context now with Helen Qiao, who's with us right now out of BofA Global Research, Chief Greater China Economist. Your initial reaction to everything that we just mentioned.
Yeah. I would say that there are probably two major takeaways. The first one is that most of the growth was probably still contributed by the external sector, and the turnaround, for example, in IP in June pretty much proved that activities in the manufacturing sector were holding up okay, but that was probably largely should be attributed to the external part, and that's probably related to the trade war truce and also the front-loaded orders potentially. Because at the same time, if we look at investment and consumption proxies, they're not necessarily doing too well. So I think the first and most important reading is that growth has been holding up, but to a large extent helped by the external demand still. So China remains to be dependent on the external part. And the second thing is that overall speaking, growth still seems to be pretty weak on the domestic end. Not only the numbers we just received on retail sales, yes, of course, it's probably affected by the, 618, the 618, shopping festival, being brought forward this year. It's probably also affected by the temporary halt of the trade-in programs, the subsidies by local governments. It went on and off for a little while. And however, there is no denial in the fact that overall demand must have been weak, underlying in the data, so that CPI inflation was barely struggling to stay above zero. And that's adding to the retail sales, so that as a nominal number, it's now in the 4 handle.
What's needed then, right? You mentioned, if subsidies in the consumption space are going to start to fade in the second half, what is it needed then to boost that consumer confidence in this economy again?
That's a billion-dollar question, Yvonne.
Keep asking you every time.
Yeah.
Well, I think that the policymakers and observers, scholars, everybody is still talking about this big time. But I think the consensus is that for Chinese consumers to feel more confident to spend, it is not enough to just give them some cash and say, oh, here's a coupon and go out and spend. This is for every 200 yuan you can deduct a 30 yuan or something. So it's a big coupon. That's not enough because people may not see it as sustainable. I think that for consumer spending to come back more sustainably, basically we need people's expectation on their income and future income to come back. So that is the most important part that is linked to fundamentally to the labor market outcome.
And what part of the economy links to the employment situation now? And if you had to pick the external environment, if it's domestic consumption and chicken and the egg there, what is able to boost job prospects looking at the next, let's call it 2 years?
Well, yeah, this is all linked, right? The investment returns have been relatively low.
Yeah.
People are worried about, investing today and not necessarily reaping, a high return in the longer term. If investors are not investing, then who is going to create the jobs? So I think that, oftentimes, yesterday we were at this forum and we were having this debate. People are talking about boosting consumption being the most important priority for China. But, my view is that it's even more important to boost investment, especially to create those high-paying jobs. At the moment, if it is just the exports, right, the benefit, the areas that benefited from the external sector remains limited. We need to see, for example, high-end manufacturing and also not only that, but also service sector generally doing better so that actually they can create more high-paying jobs.
There's a lot of talk about this whole supply-side reform now. Given just the price competition, the price wars we're seeing in almost every sector in the consumption space. It's very different from what we saw back in 2014, 2015. These were more state-owned enterprises. Now we're talking things that are more in the private sector. How do you do so, this whole anti-involution sort of effort, without killing jobs and growth?
That's right. The anti-involution, 反内卷, right? It's the new keyword in town. Everybody is talking about how exactly can you do that. At the end of the day, Yvonne, I think the problem of people cutting, their prices, trying to overcompete each other, and even private companies doing that without any subsidies, etc., is a fundamental reflection of the fact that your demand is too weak. Right, if you look at the production side, the supply did not grow that fast. right? So the reason why you have such a big oversupply problem is because your demand didn't catch up. So it went back to, whether people are confident enough to spend and to invest. So we need to boost the sentiment, and especially to boost the consumption, to create the high-paying jobs, so that people would be happy to spend. So that, I think, is quite critical. And hopefully in the near future we can see some policies towards that. But at the moment, I have this feel that policymakers probably are more or less more in the comfort zone at the moment, especially because of the de-escalation in the trade war. And therefore, in the near term, we may not necessarily be able to see any trade, any potentially interest rate cuts, triple R cuts, or fiscal deficit expansion.
Do we know enough about the anti-involution campaign to affect your inflation forecasts?
Well,
or does it, is the best case it engenders inflation to come through?
I think that this is one of the most frequently asked questions. Is China more aware of the deflation pressure and therefore doing this anti-involution campaign, etc.? So would that help? Well, from what we learned, I think that it is more probably sector specific, and probably it will focus more on, for example, the solar sector, cement sector, rather than coal or, for example, especially steel. And therefore, this is not like top down, every single sector being affected. And going back to what we said, ultimately, this is because you don't have enough demand.
Right.
And unless you stimulate your demand effectively, you will still have a lot of overcapacity, right? So the prices are generally still going to remain relatively weak unless people are expecting much better, tomorrow in terms of investment returns as well as their income.
The property side still remains the big sort of headwind, right? We take a look at how new home prices are dropping faster than the previous month. We just saw China Vanke talking about its loss for the first half could reach as high as $1.7 billion. And there's a lot of speculation of some big housing stimulus on its way. Is it on its way?
Well, I think last week people got carried away, and many were expecting, a big conference would take place, and therefore there will be a lot of pro-urbanization and probably this kind of local governments borrowing to support it, and therefore there is going to be something like what happened in 2015, basically, right? I remain skeptical. We haven't heard specific news that this is the case. And most importantly, let's assume for a second, Yvonne, that it is the case. Let's bring over what exactly that was said back in 2015 to today. Will we have the same impact? My suspicion is probably not. I very much doubt that people would still assume the same thing would just unravel like in the past. And therefore, I would say that what we are waiting for is probably some strong signal in property policies. In terms of maybe relaxing the restrictions of purchases in Tier 1 cities, and maybe some other kind of suggestions that more encourage people to buy and hold for the long term. But I doubt that this is going to come back to the whole 2015, 2016 story.
Yeah, the shantytown. We're not going to get shantytown 2.0.
Yeah.
What expectations then do you have over this upcoming Politburo meeting, and any cyclical measures that you expect to likely come through in the second half?
Well, I would say that I probably wouldn't be holding my breath for some major delivery of bazooka packages, because after all, if you look at the data today, right, 5.2% is not a bad number for the second quarter as a whole, and also for the first half. 5.3% essentially buys them a lot of room, right, for the second half. They don't have to grow by 4.7%, 4.8% in the second half. They can grow even slightly less than that to actually reach the range of 4.7 to 5.3. So I think that at the moment, policymakers might feel a little bit more comfortable, and therefore I would expect that for the Politburo meeting, most important policy event in the near future is probably going to be a non-event. With very limited, policy stimulus upside being delivered there, because policymakers right now feel, relatively comfortable.
Helen, great to have you. Helen Qiao there, Chief Greater China Economist at BofA Global Research. And of course, as we're talking about property, we continue to see what's going on in some of these property stocks here listed in Hong Kong. Continue to see a bit of a massive drop there. But the Hang Seng is doing quite well. This on the back, of course, the big news that we got in the last couple of minutes of Nvidia expecting that license to sell H20 AI chips to China again. Shanghai Comp, though, is heading the opposite direction, but HS Tech is loving that news here right now. Particularly when it comes to property stocks in China, though, that index basically has continued to drop after that new home price data came out.
Yeah, this one is really the one that's moving against the grain. This is moving on the property price numbers, which came through. But again, as Yvonne is pointing out, this is really one of those days where the U.S. side of things is really what's leading to Chinese markets doing what they're doing. U.S. futures coming up on your screens on the Nvidia line coming through ahead of Jensen Huang's visit to Beijing. There we go. We're now green across your screens. And the other story we're tracking to is this backing up of yields in Japan. And we're now hitting some key milestones here on the 20, 30, and 10-year yields in Japan, levels that we haven't seen in some cases this millennia. Plenty more ahead. This is Bloomberg. Right, what a difference 30 minutes makes here. In the case of U.S. futures, the Nvidia story is somewhat putting a decent bid underneath futures, which we're down, and now, as you can see, up just about across the board here. We're down, up now about 90 points on NASDAQ futures on this headline that we're going to get into right now, in fact.
Yep, the big news really, right? Nvidia is saying in a blog post that it plans to resume sales of its H20 artificial intelligence accelerators to China. This comes after it received assurances from the U.S. government that it would be granted the necessary licenses. Let's bring in our chief Northeastern correspondent, Stephen Ingles, on how big of a news this is.
Yeah, it's pretty big. I mean, Jensen Huang, the CEO of Nvidia, has been lobbying quite hard, saying that these export controls on the chips, including the H20, is damaging America's chip makers' competitiveness, selling into the world's biggest semiconductor market, that, of course, is China, and giving an unfair advantage to domestic competitors like Huawei. And of course, Jensen Huang just had a meeting at the White House for many hours with Donald Trump. I don't know what he was told, but we start connecting the dots here because Jensen Huang is in Beijing this week as well. He'll be meeting with the Chinese trade negotiator He Lifeng, as well as the commerce minister. And so essentially, this is not necessarily from sources. This is from an Nvidia blog post saying it plans to resume selling the H20 AI accelerator to China after receiving assurances from the U.S. government it would be granted those licenses. Now, keep in mind, the H20 was the sort of scaled down version of the high-end AI accelerators that were specifically designed for China. And until April, when those export controls from the U.S. government were expanded and included the H20, that was the main product they were selling. In the meantime as well, Jensen Huang was talking about they're building another China-specific, because the H20 was blocked in April. They were building another one based on the existing Blackwell RTX Pro 6000 infrastructure that was possibly going to be unveiled in September. Now, I don't know whether this development puts that on ice. I don't think so. I think they're going to continue with that as well. But with the H20, essentially, according to this blog post, being allowed to be sold into China again is a big development for Nvidia. They were warning the export curbs on the H20 essentially could, see sales in the second quarter drop by $8 billion because of that. So that's a big revenue source that was essentially cut off by the export controls. I don't know what the nature of the dialogue with Donald Trump was. I don't know the nature of the conversations he can have in Beijing, but it looks like he's going to Beijing with a pretty positive message.
Yeah, I guess to your point, it was perhaps clear enough for them to come out with something as clear as this headline. And I think the temptation now, Steve, is for me to conclude, does this mean that semiconductor supremacy, national security, those bigger issues are no longer big issues?
Or transactional.
Or transactional. Yeah. And I think I'm now tempted to think, is that no longer the case? Or will the U.S. perhaps explore other avenues.
Negotiations on the trade front are give and take, right? So the Chinese had long been complaining about these export controls and limiting even to the H20, which is already a scaled back version of the most prominent AI accelerators. So China lobbied hard on that. And there must be some reasons why the Chinese and the United States were able to reach a second truce in London after Geneva. There must be some give and take here. Now, this would imply that he did get the assurances from Trump that the export licenses will be approved. Because, again, Huang told Nvidia customers they're applying for those new licenses for H20 export licenses to sell to China and expects those to be approved and deliveries could resume soon. So it looks as though after that meeting with Donald Trump, the approval process, the tacit approval to Nvidia has been given, and that Jensen Huang is able to go to Beijing now and deliver that news.
Yeah, that's going to be our big story tomorrow, of course, that visit, and of course the market reaction in Nvidia later today. Steve, thank you so much. Stephen Engel there, our Chief North Asia correspondent there. And really the bigger issue that we alluded to there is, the transactional nature of the conversations here around negotiations with President Trump at the center of that. And really when you look at the Russia part of the conversation here, Trump has again threatened, and this was the big one, of course, yesterday, to impose quite stiff financial penalties and perhaps sanctions here on Russia if Russia does not end hostilities with Ukraine. He's also promised to send more weapons for Kyiv, including Patriot air defense systems. Have a listen.
We're very, very unhappy with him, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is.
Okay, Bill Ferries is with us to help us fill in the details there. Yeah, Bill, what do we know? And 90 days, I mean, I remember Donald Trump going into the election said, I could end this war in 1 day, and here we are. Where does this leave that part of the conversation, Bill?
Yeah, it's definitely an interesting development in terms of Trump's apparent increasing frustration with Vladimir Putin. He talked about 100% tariffs on Russia, but he described them as secondary tariffs, which I think he's referring to secondary sanctions. Russia is obviously still under heavy U.S. sanctions and has been since the Biden administration. But secondary sanctions would presumably hit some of the few goods that Russia is allowed to sell internationally, and that would be oil. And the customers for those goods would be basically India and China. So he did set a 50-day deadline, which was longer than a lot of Trump deadlines. That's quite a ways in the future, so I think there's going to be a lot of time for this to work out. But I think the big picture is here, he hasn't gotten that peace deal, that end of the war that he promised. He's been increasingly frustrated in public with the fact that the war is continuing and that Russia continues to send some of its biggest drone barrages against Ukraine. So I think that's really the sign of what's happening here. He is allowing some weapons sales to Ukraine to resume. So I think there's 50 days in which the battlefield will continue to develop. But I do think the big picture here is that Trump has not gotten his way with Russia and Ukraine, and he is leaning more on the Ukrainian side at this point, but continuing to leave a little bit of a window here for Vladimir Putin if he wants to go through it.
Yeah, it's very interesting. Very different sort of circumstances given what we saw back in February when Zelensky was sitting at that very chair where Mark Rutte was sitting. And it seemed like Trump was in some ways blaming, Kyiv for, the victim here for the war instead of the aggressor, Moscow. It's such a turn of events in some ways, Bill.
Yeah, it really is. But, you know, the thing that Donald Trump campaigned on was really one of the things was this the massive over $100 billion packages of support that were going for Ukraine. A lot of his supporters were frustrated to see the U.S. spending that kind of money. He made it very clear with sitting there with the NATO Secretary General that NATO partners would be buying U.S. weapon systems and then transferring those to Ukraine. So he's trying to make this as something the U.S. is not providing military aid. It is selling weapons. It's getting paid for those weapon systems. And then NATO is transferring those. So that's a message to his base. But there's also a very clear message here that he hasn't perhaps thrown in the towel on a peace deal with Russia, but he is not happy with the way things have developed since he took office in January.
There, our senior editor joining us out of Singapore. And of course, this against a backdrop where we have heard from President Trump saying he is open to talks with the EU, of course, after threatening some 30% levels when it comes to tariffs there. All right, we'll have plenty more to come. This is Bloomberg. 'Taking a look at movers, the tech space certainly is on fire today. Bilibili is certainly one of them. They're getting an upgrade from HSBC, so they're raising their target when it comes to the monetization of its game and ad businesses, of course, and also that share repurchase plan. The stock's up some 5%. Li-Ning, though, that's the one that's a bit of a sore spot there. After we saw weak sales and a cautious outlook there from the sport maker there, and Top Sports, City opening a 30-day upside catalyst there on the ongoing recovery of Nike China in the second half of this year. Plenty more ahead. This is Bloomberg. 11:29 a.m. in Tokyo. Japanese markets are heading into that lunch break here. You know, the equity space is not doing much. It's all really focused on what's going on long rates in the JGB market here right now. We've talked about how we've broken through plenty of thresholds here when it comes to 10s, 20s, 30s, and 40s in the JGB market, and really bringing it back to like the levels that we haven't seen since 2008, for example, here. So it really was started with the 40-year yesterday, and we are continuing on with this sell-off here today, where you are now seeing now a 4 basis point sort of pop there when it comes to the 30-year at 3.2%. But that 10-year yield now is at the highest we've seen since 2008, Dave.
Yeah, and it's really been, I think this is really at the front and center of what's recently been a very painful spot for government bonds. A Bloomberg gauge of government bonds, the one we were just making here, right? So Europe, you saw the melt up in bonds, for example, treasuries included there. The worst 6-day spell in about 2 months on government bonds. And it goes into maybe, is this in some ways adding back risk premium into the market? I was going to say yes until the Nvidia story came out and did this to your screens, right? So mostly green on your screens right now. Asia Pacific up 1%, and S&P futures, which was down early on, that contract is now slightly to the upside, as with most sectors in the green today. Let's get more context on the market action today. Joining us here in set is Paul Dobson, our executive editor for Asian markets. So what's the big talking point among your team today?
Yeah, well, obviously we're very interested in what's going on at the back end of the yield curve and with those Japanese government bonds and what it means not just for the market in Japan, but what it means for global markets and what it means for the economy as well. I think that people are starting to pay more and more attention to the fact that higher yields on those government bonds is going to start to drive up borrowing costs in the real economy, mortgage rates and the such like, and that in turn will start to, make it even harder for the government to sort of encourage growth if it needs to continue to issue more bonds to subsidize the consumers more because it's worried about the economy and it needs to boost growth. We get in that kind of downward spiral that the market and the rating companies are all very worried about at the moment, and that's what's being expressed in the way that those bonds are trading at this time.
That could be a headwind for stocks, but then I take a look at news like Nvidia saying that they are planning to resume their chips to China. Mm-hmm. How big of a news is that? How could that really propel AI stocks moving forward now?
I mean, It's good news, sort of top down. It's good news for Nvidia, certainly. It's probably good news for the Chinese companies that want to buy them. It's bad news, obviously, for the competitors and producers of chips within China who, kind of are competing for that same sort of space. And it will be interesting to see whether they're allowed to continue with it or not, given all of those restrictions that we've seen from the Trump administration and his efforts to cajole more countries around the world to sort of limit the availability of the chips for China as well.
All right, Paul. Thank you, Paul Dalton there, our Bloomberg executive editor for Asian markets there. Perfect day to have him here to talk about all these sort of things that are happening, right? Melt up in yields and, of course, HS Tech on fire on that Nvidia news. Yeah, so interesting. So about an hour into the session, the big stories we're talking about now were certainly nowhere near in our plans earlier on. So CSI 300 has done well of late. Yeah. I think you guys covered this while I was away. Highest level so far of the year. We're continuing to see those gains. In fact, today, coming up on your screens right now is 2.3% already on the main benchmark in mainland China. It's taken out, as you can see, the high back in March. Now, speaking of highs that we are looking to take out, the Hang Seng Index, which a lot of analysts and strategists have told us it has been in the range of late, is now, in fact, testing the upper end of the range. We were looking for a domestic catalyst to do this. What we got was an external catalyst in the form of the Nvidia headline, and maybe as a proxy of this pullback in geopolitical risk, maybe. So this is a level we're tracking very, very closely. What got us to this point, though, in terms of sector movers, is really healthcare, right? So we talk about DeepSeek, we talk about cyclicals, EVs and everything else, but it's really been this biotech moment that's coalesced to give us these gains that we've seen so far. Yeah, and they're saying this whole biotech space, quick one, the scale of which we've seen in terms of AI, in terms of innovation, the pipeline, is certainly in a way is reminiscent of what you're seeing with the likes of AI, DeepSeek, or EVs and the growth of it there. And it really is the main sector that has outperformed. If you look at month to month, year to date, it's basically healthcare that is leading the gains in this rally as well. So returns north of 40% we're talking about here. Let's bring in Cui Cui. She's been busy, head of Asia healthcare research at Jefferies. You just told me you went on a 3-month tour around the world just talking about what's going on in the China healthcare space. What is the overall response that you're getting?
So thank you, Yvonne. Yes, as you mentioned, I just came back from a 3-month non-stop global marketing. So that is the popularity and demand for China biotech at this time. So you see my outfit today. I'm wearing this because today we're going to talk about China biotech shining on the global stage. Okay. So it is very interesting that because year to date, I think my investor base at least double because aside from the emerging market journalists, nowadays, all of the global healthcare specialists, they are looking at China. So I think you will be very surprised to see that how many Chinese biotech talents sitting on Wall Street who never looked at China before. Yeah. So maybe it's an opportune time to take stock, right? So we're about 50% into the rally this year, more if you measure it back from late last year. What exactly does China lead right now as far as biotech? Where in the world is it head and shoulders above New Year's competition, and where is it still lagging? Yes, so exactly. So for this year, I think the main thing is still about the China biotech out-licensing deals. So year to date, we are talking about, we see 32% of the innovative drugs out-licensing deal was from China. So this number was only 21% in the past 2 years, and previously it is only single-digit percentage. So what drives this kind of improvement? I think few things. So first of all, from the multinational company perspective, I think first of all, they are facing this kind of increasing drug pricing pressure from Trump government. And on the other hand, a lot of the blockbuster drug patent expiry is also imminent. We're talking about like Keytruda, which is the bestseller of human history. The patent will expire in 2028. Okay. So I think the out-licensing from China, or maybe the in-licensing from China, will provide a quick fix to this multinational company, because we're talking about in-licensing from China will save about 60 to 70% in terms of cost. And in the meantime, it is also 30 to 50% faster. So we're talking about cheaper and faster.
Where do you see, as maybe a follow-up to David, where are things they might be still lacking, right? We had a great big take that talked about there's still a bit of risk aversion in terms of innovation, right? They're still kind of making better versions of things that have existed and not really coming out with novel treatments.
Yeah.
Where are we on that?
So I think, first of all, we need to thank to our government, because remember back to 2018, so during that time, Chinese government is very harsh on the generic drug pricing. So we have a bunch of like the so-called VBP, volume bundle procurement, this kind of stuff. So that also forced most of the pharma companies to have a transition to more innovativeness. So that is one. And in the meantime, remember in 2018, it is the first time the Hong Kong Exchange also opened up Chapter 18A to allow the pre-revenue biotech companies, as long as you can provide some innovation, you can now come to the Hong Kong market to list. So I think all this kind of very supportive initiatives help the Chinese biotech companies to now becoming more competitive around the global peers. Yeah.
What's the revenue outlook? And to be more specific, what is the ex-China revenue outlook? And do any of the geopolitical gyrations affect
200% tariffs?
200% tariffs.
Yeah, so great question.
US.
Great question. So regarding the tariff, so remember it is exactly last Tuesday Trump announced this kind of 200 drug tariff, right? So first of all, I think after the U.S. tobacco trade, I'm sensing that the market is getting less sensitive to the Sino-U.S. tension. And I believe that the ultimate goal for the Trump government to announce this kind of drug tariff, it is ultimately for manufacturing localization, right? But I think, as we mentioned before, because now pharma companies are facing increasing pricing pressure because this has already been escalated to a national security level. So that's the reason why I think U.S. government, they have to offer some cost flexibilities to the U.S. pharma guys. And in the meantime, we're talking about, in case of the worst case scenario, while Trump insists on this kind of manufacturing localization, then do not forget, so like WuXi Biologics, along with Lambda, Fujifilm, they all have the U.S. facilities, while like Samsung Biologics, they still do not have anything outside Korea yet. So I don't think we should be too concerned about this regarding China. And back to the economic side, I don't think U.S. government will have an issue with the China biotech out-licensing. Why? Because by the partnership nature, the China biotech will only entitled to 10% of the U.S. sales. So it is the U.S. farmer who are going to keep majority of the economics. So that's the reason why I think this kind of China biotech and U.S. farmer partnership, well, it's actually a fair and also sustainable way.
Your latest report is shopping in this sort of biotech supermarket. What are you shopping for? What are some of the best buys then right now?
Yeah, so for me, because this is more from the product perspective, but from company perspective, I would say for the biotech space, we prefer Akeso. And I believe the Akeso chairlady, Michelle, she was also on the Bloomberg China show that 2 months earlier. And Akeso remains the best Chinese biotech companies year to date. And also, Duality is also another pick from China biotech space. And in pharma, we like Hansoh Pharma and also Hengrui Medicine. And also, do not forget, like the Chinese CDMOs, they are like a beneficiary as well as a proxy to the China biotech out-licensing wave. Because the thing is, it's actually very natural and straightforward for the U.S. pharma companies to give the order to WuXi because their Chinese partners already engage with them. So WuXi Biologics and as well as WuXi XDC, we like all of this thing. And
just very quickly, where do you think the rally's gotten maybe slightly too far ahead of fundamentals?
Debatable, I would say, as I mentioned, because like with the incremental fund flow, hopefully, from all of this kind of like spot on the China healthcare space, regarding from either the emerging market generalists as well as the global healthcare specialists, I do think this kind of the China biotech rally will be sustainable.
Yeah, okay. You guys need to tell your boss to hire more people. You know? We can't send you on a 3-month global marketing tour and straight to the set. Fantastic. Thank you so much.
Thank you, David. Thank you, Yvonne.
Nice to see you. Cui Cui there, head of Asia Healthcare Research at Jefferies. They're getting busy. Best performing group, of course, within this Chinese equity market this year. Plenty more ahead. This is Bloomberg. Welcome back. You're watching the China Show. Chinese tech stocks are catching a bit. You have data center stocks also outperforming, as you can see. U.S. futures have now reversed early weakness and are now also in the green on the back of this blog post out of Nvidia that it's planning to resume sale, or it expects to plan to resume sales here of its H20 AI chips to China. Joining us now on the phone is Gene Munster, managing partner and co-founder at Deepwater Asset Management. Gene, I guess, well, thank you so much for joining us fairly last minute. My first question is, can we take this at face value? Is this likely going to happen now again?
I mean, it would be, I think, a big shock if it didn't happen at this point. They're a credible company, and so the fact that they said this, I think you can say that it's 95% chance that it's going to happen. And then it kind of quickly begs the question, what does that mean for all the numbers here? And I want to back up about 3 months ago when Jensen highlighted that the lack of the H20, those curbs, had a negative 15% impact on their business. And so the most basic math here is that if you take the curbs away, you add 15% back to the street numbers. I do want to caution that of the 40 analysts, by my count, 8 of those 40 analysts had already expected the curbs to be pulled by the end of the current quarter. And so the reality is, what does this kind of mean for the stock? Where do you expect it to start to trade tomorrow? My guess is it's probably up somewhere between 5 and 7% because there's going to be basically a 10% add back to those numbers. So this is a material news. It's coming several months, probably 6 months earlier than what I had been expecting.
Gene, what does it tell you on where the Trump administration is thinking now about these export curbs, right? Before they said, look, even with these, AI chips to China, they're 1 to 2 generations old. They can still help China to catch up in their AI ambitions. Have they reversed that sort of thinking now? What's your take?
Well, the truth is always several layers below the surface. And in this case, the truth is orbiting somewhat around some of these rare earths, these famous magnets that the U.S. is looking for more military applications. It may seem like a distant topic to NVIDIA, but in reality, that the U.S. is very keen on getting these rare metals. And China very much wants to have access to some of this more advanced computing. And so my suspicion is that some of this, this kind of semi-trade truce, I'm reluctant given everything that's going on to call it that, but that we have seen between the U.S. and China probably laid the groundwork a few weeks ago that this, in fact, was going to happen with NVIDIA. And so what does it mean? What is the Trump administration essentially saying is that they have to give something to get something. I do want to stress is that I've had several conversations over the past couple months with former U.S. trade officials that worked in the original Trump administration and still have a role in terms of advising the Trump administration. And they've stressed to me that there is still this goal of the Trump administration to bring more tech into the U.S. and to keep that tech in the U.S. And so I don't think that this is over entirely. I think that kind of the long term here is still going to be a bias for the U.S. to want to do this and probably for the U.S. to find other ways to get some of these rare metals that have been kind of caught up in the whole NVIDIA conversation.
Yeah, Gene, that's where my mind, in fact, automatically went. If they're loosening on this front, where do we then expect that tightening to show up?
So the tightening, well, first, the loosening of this, as I mentioned, probably allows China to loosen some things that the U.S. won. But in terms of kind of where do things tighten up, in the near term, it's not going to be tightening up. It's probably tightening up in the next 2 years and beyond. And I think for NVIDIA investors, I mean, here's the punchline, is that the street is looking for 25% growth for calendar 26 before the announcement. This tightening isn't going to happen anytime before the end of next year. These are very long-term trends, so I don't think investors should be concerned about that. And that 25% growth number, probably tomorrow, those estimates get revised to 30 to 35% growth for next year. And so nice step up. I do think they'll ultimately exceed that higher number because of all the good things that are going on with their business.
What does this mean for the likes of Huawei, who were seen to be, in some ways, these export curbs in the U.S. were, they were going to benefit from this, and that more companies were going to be using their AI chips? Is this going to stunt them a little bit in terms of their growth prospects?
Yeah, undoubtedly it will. And I think from the perspective, this has undoubtedly shaken some of the China check industry, and so they'll be relieved to get these H20 chips. They'll buy them in abundance for the next year and a half, but they're going to want to find additional sources for these chips. And so I think Huawei is still going to have a great business in China.
Gene, final question for you. The obvious name to buy, clearly, if that's not even clear at this point, is Nvidia. What other names do you think get to ride this boat over the short term?
So I think your viewers should take one thing. The most primary piece to take away is that there's a huge amount of demand for these chips. The reason why China's been advocating to get these H20s back or equivalent of it is because they need them. And I think people should take away that ultimately we're still much earlier in the AI trade than what maybe you realized a few months ago. And that will benefit across the board on the AI infrastructure companies. I mean, it's a list of 20 companies. And so if you were thinking we were going to somehow see a slowing second derivative effect in the growth of these companies, you may want to rethink that. I think the growth is going to be higher for longer.
Gene, it's great to have you. Thanks for coming on the show so last minute. Gene Munster there, managing partner and co-founder at Deepwater Asset Management, joining us out of Minneapolis here this evening. We're going to send you some pictures out of Beijing here this morning. There is a press briefing underway, of course, after that data dump out of China, where we did see basically a mixed bag, right? So GDP did beat the estimate of 5.2%. These are the year-on-year numbers as well. Retail sales was sort of the miss. Industrial production, though, did do better than expected, 6.8% year-on-year. What we're hearing from the Bureau, or at least what the officials are saying now, Bureau of Statistics is talking about consumption. So they're saying the consumption momentum will continue in the second half. Local governments to roll out measures to drive consumption. We know we've been talking about these consumption subsidies. There are some local governments that have been, in terms of the funds, running dry of late. So a lot of doubts of whether they can continue with these sort of subsidies and coupons and the like. But we are hearing now consumption is now the backbone of economic growth. But when you talk to a lot of economists, it still seems to be a very, I guess, two-tier sort of consumption sector, right? When you have new consumption where people are still very much buying the like the Labubus and Labubu Gold. Yeah. But traditional sort of consumption is still a bit lukewarm. Where you really want them to buy both. Yeah. And, the economists that we ask here is, it's still, there is still no answer to that question of how do you revive animal spirits in the market. And that might be down to the other thing that they're just mentioning right now is maybe once they're able to fix the housing market, then other things will fall into place. And, that's a line that we could have said last year and a year before that. But to that very point, officials are not talking about how there is a greater needs greater efforts to stabilize on that very point the housing market. And the data does suggest, of course, they do need to do more along that front. Yeah, so new home prices that we just got in about an hour and a half ago did suggest that, we see bigger drops than we did in previous months as well. We're going to leave that there. For Bloomberg subscribers, you can continue watching at Live Go. You also find big diary entries coming up today and later on this week, as well as some of the events you may have missed earlier. We got plenty more ahead. This is Bloomberg.
Right, welcome back. As we approach the 90-minute mark of the cash markets, really one pain point in this equity market, which, by the way, is doing well, 3.5% to the downside on the Bloomberg property gauge. The numbers are self-explanatory and why we are getting this adverse market reaction. 25 straight months of home price declines, an acceleration, of course, in June compared to May.
Yeah, and you contrast that to what the tech space is doing, and it's a whole different sort of story here after we heard from Nvidia getting that nod from D.C., it seems, to resume their shipments and sales of those H20 China chips as well. You're seeing the big names all rallying here today. Taiwan Semi is up close to 1.5% here as well. So certainly it seems like the lobbying from Jensen Huang has worked as he heads to Beijing this week.
Yeah, that's going to be our big story.
China, I should say.
We'll see you all tomorrow. The Hang Seng Index was at session highs. We're near session lows. The day is young, but we'll see you all tomorrow. This is Bloomberg.